Welcome back. Earlier this week, wholesale inventories were released, and what we're going to see is there's a pretty wide divergence between sectors. On a month over month basis, we can see the biggest increase in wholesale inventories is petroleum products. Conversely, apparel inventories is down by the most at 2.4%. Now, wholesale inventories measures a change in goods held in inventory. These are reported in millions of dollars. High and low inventories reflect strong or weak retail demand. So when we see high levels of inventory, this is actually a negative. It means the sellers can't sell their inventory. It's a sign of weakness when we look at our own stock portfolios. We're going to take a look at a number of different sectors. When we take a look at our own stock portfolios, keep this in mind. This will reflect the strength or weakness within the different sectors. And wholesale inventory speaks directly to how GDP may be expanding or contracting. Lately, GDP was expanding. On a year over year basis, we see motor vehicle parts and supplies up 14%, machinery, equipment, and supplies up 20%, metals and materials up 13. Those were the increases, the negative increases. Negative meaning because we don't want to see higher inventories, means the stores can't sell. Conversely, the biggest decrease in inventories, 27% year over year basis, farm product raw materials, apparel down 20%, computer equipment software down 20%, chemical and allied products. Now, as we take a look at the different charts, notice that there's a certain theme, especially with those rising inventories. Number one, and the black line here is the S&P 500, just to give us a little context as far as where we are. The red line represents motor vehicle parts and supplies, record high inventories. And the theme that I think you can apply across the board to these high inventories, especially, is that they're sensitive to interest rates. High interest rates make it very difficult to buy cars or even motor vehicle parts and supplies used to repair used cars to an extent. Inventories are at record highs. Also at record highs, this is a standard durable goods number. Now, this is durable goods as we talk about things that are meant to last more than 5 years, washing machines, appliances, things like that. Record highs, and this is also very sensitive to interest rates. If we can't afford to buy a new house, then we're not going to, have the need for a new appliance, a new washing machine. Petroleum products, very closely linked to the automotive sector, also not at record highs, but not that far away either. Machinery, equipment, and supplies, and this speaks directly to the investment in manufacturing, which we know lately has been weak when we look at the Empire State Manufacturing Index, the Philly Fed. Machinery inventories at record highs. Now, this is a little bit better. Beer, wine, and distilled alcohol beverages, they are selling better than the automotive parts, to be sure. Inventory is not at record highs, not that far away either, but not trending at new highs either. Now we start to see the sectors with lower inventories, meaning they're selling more. And we put these in order. What we saw starting out with were the highest inventories, and now we're moving down. Lumber and construction materials, that's starting to move to the downside. We can see we're certainly quite a bit ways off of our record highs. Lumber and construction materials are selling. Of course, it is linked to interest rates, but maybe not, affected as much. Apparel, this is very much off of our record highs. Our record highs are on 42,000. Of course, this is, calculated for much bigger multiples, but we're now at the 35 level. So apparel is selling at a better rate, not as sensitive to interest rates. Chemical and allied products, very similar chart as well. We take a look at farm product raw materials. Remember, this was the biggest decline in inventories, farm products and raw materials. And we see we hit those very significant highs earlier this year as a result, in part, maybe of, all that inflation. We were consuming less, but maybe because inflation's coming down to some extent, at least in the food category. Maybe this is helping. Metals and materials, minerals, I should say, also down to some extent. Computer equipment and software, not as sensitive to higher interest rates. It's not that expensive to go out there and buy a new laptop or cell phone. And then we see overall the change. Now, the biggest move to the upside, petroleum products over here. Inventories are skyrocketing. Farm products and raw materials, that's a lighter orange line moving to the downside. So the takeaway from this is when we look at our stock portfolios, try to think of those sectors that we may be invested in. Ideally, we'd like to be invested in sectors that are doing well, that the inventories are, not staying on the shelves very long. On the other hand, if we're looking for some sort of, a value play, buy something that's already very weak, maybe take a look at these high inventory sectors if we're looking for a reversal. We have a big economic calendar, as always, and we'll be sure to update you along the way with any significant changes. We hope this has been helpful. We look forward to seeing you back soon.